there is like a whole big bunch of people in the market today because of indexing.
Yes.
That are just buying like globally diversified index funds. Although I sound like I'm globally diversified, right?
Yes.
I have a big concentration in this space.
Yeah. You think a global index is diversified, but in reality, it's very concentrated. And so what you need to do is you need to do the diversification yourself. I want to have exposure to the whole world, and I want to have exposure to the whole world with broadly equal weights between the US, Europe, and Asia. That's a decision I make. An investor sitting in Singapore might say, I'm sitting in Asia. I think Asia is the most dynamic region of the world. You should actively choose, rather than buying a world index, which has the concentration that we've talked about, you should make 2 or 3 choices to diversify yourself.
Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut, and today we are in a different view. We are all the way in Paris in Amundi's studio. So we just completed the event, the Amundi World Investment Forum. Very fun, very exciting. Check out our reel, check out our posts. But I think we've taken some time to digest, and we are in the studio to discuss and break down a little bit more of what has been discussed at the forum, and also to kind of lay down a worldview that Amundi has for all of us. So we are joined in studio with Guy, the head of developed market research. So for our audience that maybe don't quite know you yet, could you just introduce yourself?
Of course, yes. First of all, I have to say thank you very much for having me in to talk to you. My name is Guy Stear. I work within the Amundi Investment Institute, which is a group of 55 macro specialists across the world. My particular area of speciality is in the developed markets, so that's more or less the G7, a little bit larger definition, but it's both the fixed income side, so government bonds and corporate bonds, and the equity side as well. So it covers those areas.
Okay, so maybe for our audience, what is... Because I think different houses have a little bit of a different definition of what is considered a developed market.
Sure.
Right? So what is developed to you?
Sure. It's a somewhat archaic definition. No, you're absolutely right. Because in a lot of indices, for example, Korea is not a developed market. And let's be honest, few places in the world.
And it's doing so well, right?
Yes, indeed. So we do tend to sort of follow the standard definitions, but in some areas, for example, there's a lot of overlap. So I won't necessarily look at China, but China matters a lot to the countries that I do look at. So there'll be a lot of discussion between my colleagues on the emerging markets and what we do.
Okay, fair. So maybe, for a start, you could kind of just lay out some of these views of what we've kind of gathered at the Amundi World Investment Forum, right? So for me, from my point of view, my experience there is like the whole event is trying to lay down this idea of like, you got to be more diversified out of the US, right? You got to look at other places. You got to look at Europe, you got to look at Asia, but I want to hear your point of view.
I think you did a good job in sort of summing up
Thank
right
you.
there. I mean, I think the most important thing is if you're an equity investor and you think about how the world equity indices are weighted, 2/3 of your investment would be in the US. And a big part of that 2/3, so roughly 1/3 of that 2/3, would be particularly in the tech sector in the US, which has had a phenomenal performance. And the earnings growth has been very, very impressive. But the question I think you need to be asking yourself now is what next? What happens next? And because of the strong performance in the US, you pay a lot, very high multiples. So for the earnings that you're getting today, you pay a lot because you're expected that the growth which you've had over the past 3 to 4 years will continue over the next 3 to 4 years. Okay, and it may do. It may get that kind of growth. But our feeling is that what you need to think about is that we're most probably going to face the next leg of artificial intelligence. And you need to ask yourself, how will the next leg of artificial intelligence differ from what we've seen so far? And the real key here is that we're talking about artificial intelligence in the physical world. So what is that? That's basically drones, that's robots, that's transport, that's near space, that's healthcare, these kind of areas. So what we have now is artificial intelligence that's fantastic at writing software and helping you write software. I don't know if you write software yourself.
I don't, but we use it quite a
Of course.
lot. Yeah.
Well, I spend about 1 day a week writing software, and I can tell you I'm about 10 times as efficient as I used to be.
I know, right? Yeah.
Because it's when I get stuck on something, I send it to our internal artificial intelligence system, and it comes back with the answer. And it's just very, very fast. So what we have is artificial intelligence, which is great at writing software. And the question now is, what are we going to do with it? And we're going to use it to develop AI in the physical world. So the example you've come into if you look at the office that I work in, it's a skyscraper with about 10 floors, a lot of glass. And you feel sorry for the person who has to clean that glass, has to go on a pulley and clean the glass. And the reality is that should be done by a drone. And so it's going to be, this is one of many, many business opportunities that we see, is the move of artificial intelligence into the physical world. And then you need to ask yourself, what are the companies and the countries where this is going to take place? And our sense is that to build a drone, you need a different skill than to build artificial intelligence. It's more about mechanical engineering than about electrical engineering, which is what the US is amazing at, electrical engineering. But mechanical engineering is traditionally a skill of Europe, traditionally a skill of Japan, of Korea, of China, of parts of Asia, but more outside of the US. And so part of what we talk about when we talk about diversification is on the next leg of artificial intelligence, the areas of the world that are going to experience strong revenue growth are likely to be different than the areas that experienced strong revenue growth in the past 5 years.
Fair, man. That's the end of the podcast.
Sorry, I keep talking.
No, I get it.
Yeah.
I get it. No, but then I think now the hot and popular, big companies are all still listing in the US.
Sure,
right? Like all
sure.
these big tech that,
Yep.
you name the names, right? They are all like raising funds in the US. So that's still like the hot thing in the
Yes.
market at this point in time. But what you're telling me is that, that's that, right? You're going to be
Right.
paying a super premium for those things. The multiples are crazy in like hundreds of times, right?
Yeah.
Price of sales, right? So instead of focusing all your money there, you want to look at some of these other places. That's a fair statement?
That's absolutely correct. I mean, I think that the places you want to think about, first of all, I think that there's a change in terms of the type of sectors that you should really be interested in. Don't limit yourself to the tech sector per se. Think a lot more about the opportunities in industrial sectors, because the companies that will develop this technology in the physical world will really be mostly industrial companies. And the second thing is to think about companies that are good at running factories, because this is going to be, there'll be two jobs. One is developing the prototype for the drone that will wash the windows, or the drone that will paint buildings, or the drone that will build bridges. A lot of construction will be done in these areas. But there will also be the question of who's going to be able to take this prototype and make 5 million units of it. And those will be companies which are really good at process operations management, building things, running factories. And again, these are probably not the companies that everybody's focused on today. So you need to diversify out, because diversification will allow you to benefit from this change in terms of artificial intelligence.
Yeah. High-end manufacturing is often forgotten, right?
Yeah,
It's not
exactly.
sexy, not cool, not cute.
Yes.
It's
Yes,
just
but
a
it's
lot
going
of
to be
work.
very profitable.
Okay.
And so that's really the, I think for when we think about investing, that's really the opportunity.
Of course,
to
you want
focus
to
on.
enter a space where it's underappreciated,
Yes,
so then you ride
definitely.
it, right? Okay. So maybe help me understand a little bit, because when we think of being able to produce a lot, at scale, at cheap, and then export around the world, it's in East Asia.
Sure.
Right, like
Yeah.
China, Japan, Korea, Taiwan, they're phenomenal with like producing a lot of stuff,
Yes.
at scale, and be able to kind of push it out there, right?
Yep.
So then where does kind of Europe sit in this like high-end manufacturing
Well,
space?
I think there's two areas of it. The first is that there are some businesses that Europe still really dominates. So we think about machine tools, for example. Certain parts of the tech process will be dominated by the Dutch, for
Yeah,
example.
the
So
lithography,
yeah,
those kind
exactly,
of stuff. Yeah.
lithography. So there are areas where clearly Europe still has a very strong technological lead capacity. Then you have still a lot of industrialization. If you look at industrialization, industrial processes in Europe as a percentage of GDP, they've dropped. But if you look at the actual amount of euros or dollars that they've contributed to GDP, it's actually gone up over time. So there's still this base of excellence in terms of manufacturing and scale, which I think is still there and is still important. The other thing to think about is we live in a world where probably every geography is going to feel that it needs to develop and favor its own capabilities and its own abilities. So we're going to go from a world which has probably been focused on maximizing efficiency to a world which is now going to be focusing more on maximizing resilience. So these are words, but what do they mean? What they mean is that in each geography, we're going to see companies really focus on developing the prototypes and developing these products, trading with each other, but also making sure that they have the wherewithal to be involved in this next stage of AI in their own geography. So it's very difficult to pick the winners, and we try very hard to do that.
Of
obviously.
course, you have to do that.
Yes.
Yeah.
But we also are humble about that and say the advantage of diversification is it protects you in case the judgments you've made may be too early or other opportunities may turn out to be more attractive. And I'm going to give you one historical example of this. So we think about, I'm old. So in the 1990s, I worked in the internet. I was selling internet stocks in the early 2000 period. And I remember very clearly that the internet in the 1990s was an American phenomenon. It was the American telephone companies which dug up the ground and laid the unlit fiber. It was Cisco that lit the fiber. It was the IT revolution happened before the internet. So the companies that led the IT revolution were really US companies. But then the next part of the internet was putting IT on a telephone. And putting an IT on a telephone was dominated by two companies, which were both Scandinavian, Ericsson and Nokia. And so the question becomes, as we go from AI to AI in the physical world, who are the companies who are going to dominate? And the likelihood is they probably won't be US companies. They'll be companies elsewhere in the world. And we need to diversify simply to allow us to have exposure to these companies.
Okay. So let's kind of like break that down a little bit more, right? So yes, in your story, there was Nokia, there was Ericsson, yes, right? But eventually then there was like Apple, there was everyone else at the top, which built a brand so that their
Sure.
margins are much higher than, just a commodity in terms of a product, right? So maybe paint us a clearer picture on this front, right? Where we're saying that, okay, so the technology, it's already there. Now we're trying to deploy it into the real world to solve real problems, right?
Yep.
And the people or the companies that can deploy this thing historically are not in the US, right? They productize outside in Europe or in Asia, and then they will enter the market, right? So how does this thing kind of look like from a manufacturing kind of lens, and then also ultimately at the consumer, type of business at the top, right?
Yes.
Because that is the big business, right?
Yeah.
So just want to get your point of view.
I would say two things. I think first, when you think about, you translate this into manufacturing and you say, where are the business opportunities? Two types of businesses you'd like to identify. The first is businesses that will invent the product, the prototype, which will, in the example we use, the business will invent the drone that washes windows. But then you also want to identify the bigger companies that are able to scale this and have a sort of M&A capability to buy in products from elsewhere and to scale them. I think what we're going to see when we think about industrial companies is there'll be some development done within the companies, but it'll be a little bit more like the model that a lot of pharmaceutical companies have evolved towards, which is the development is done by smaller companies. The pharmaceuticals buy those molecules, and we're talking here about buying the prototypes and then scaling up the prototypes. Now, you make a good point, which is our job as investors is to think about what's going to happen tomorrow, but don't assume that tomorrow will last forever. Like eventually, Nokia was the forerunner, and eventually the baton, if you like, passed to someone else. But when you had the forerunner, that forerunner was very, very profitable. Very profitable company. So I think no investment lasts forever, but you need to think about the investment, which will be attractive for the next 3 to 5 years. And I think this is the window that we need to think about in terms of identifying companies. So hopefully that's an answer to your question.
That is pretty clear. Very cool stuff. Okay, so that's like the whole AI big story, right? Which is well and good. I think you've provided good ideas. If you don't agree, put in the comment section. The internet works this way, right?
Great.
So people will comment and then have a good
Instant
discussion.
feedback.
Yes, feedback, right? So share your thoughts and then let's see where this goes. But I also want to kind of discuss the underpinning, right? Or you want to call like the elephant in the room, which is like this US, China dynamics, right? That then drives this whole discussion of like, don't just look at the US, let's look at other places.
Yep.
And I think, Amundi is one of the front runners in this, right? To the big fund house, that goes out and say that, we believe this is the future, right? Where it's clearly two markets. It's clearly going to be fragmented. And then like, we're trying to find where to invest from this lens.
Yes.
Right. So maybe kind of expand on that part. Yeah.
Well, I think so more broadly, geopolitical risk is really something we need to think about a lot. And I think it has an impact on two different types of investment. So I'm sure that your audience don't invest just in the equity market, but they also invest in fixed income markets and money markets, at least with a part of your assets. And what we've seen this year has been really clearly a sign that geopolitical risk has a direct impact on how central banks work, and that has a direct impact on fixed income markets. So the yields that you're being offered today globally are about 50 basis points higher than the yields were at the beginning of the year because inflation has increased, because central banks have started hiking interest rates. So the market is more attractive than it was, but it has to be because the fundamentals have shifted. And I think so geopolitical risk in general across the world is something to consider. Now, when we think particularly about the US-China dynamic, competition even between countries is a very good thing because it inspires people to develop new products and do their best. But in part because we have geopolitical competition that may end up reducing sort of commercial competition between companies. It may be more difficult for companies to trade with one another, and the restrictions that we've seen in the US are probably part of what we're going to be living with over the medium term. But what this means...
So we're not going back. So we're not going back, right?
Unfortunately, probably not. And I say unfortunately because a world in which everybody trades with each other is probably the most efficient world, right? So a world in which we have limitations in terms of trade is a world which may be more resilient, but probably is a little bit less efficient. But the reality is we also need to think about translating that world into your investment. And I'm going to sound a little bit like a broken record here, but diversification is part of the solution to this.
Okay, that's a bit more broken record.
Yes. Indeed. Diversification is part of the solution to this because what it means is that countries will progress at probably different speeds and in different ways. And diversification, I think, will help protect your portfolio.
Yeah, but that's me essentially. Okay, so if we translate it to how the everyday investor kind of like run this thing, there'll be like a group of people that are like very tactical. They're looking at like different like trend sector, individual companies. Those guys will kind of figure it out, right?
Yes.
Whether they ultimately perform better than the market, that's a different story, but they will figure it out, right? And then there is like a whole big bunch of people in the market today because of indexing that are just buying like globally diversified index funds, which in the beginning beginning, you suggested, that it's like 70% the US,
Of course.
and then like in the 70%, 40% in big tech, right? So there is a big concentration risk in the US big tech. And then now you're telling me, oh, but then you got to further diversify. Okay, so I get it. If I believe in that story, I can understand that I am very concentrated,
Yes.
although I sound like I'm globally diversified, right? I
Yes.
have a big concentration
Sure.
in this space. And then now I want to go further.
Yes.
Like I am taking a position on the market.
Sure.
Right. So like, where are we looking at? How do I maneuver this, right?
I think your point is a really good one, is that you think a global index is diversified, but in reality, it's very concentrated. And so what you need to do is you need to do the diversification yourself. You need to say, let's say I'm an investor sitting in Singapore. I want to have exposure to the whole world, and I want to have exposure to the whole world with broadly equal weights between the US, Europe, and Asia. That's a decision I make. An investor sitting in Singapore might say, I'm sitting in Asia. I think Asia is the most dynamic region of the world.
Is it true?
Well, it certainly has been. And I think there's every reason to believe it could continue to be.
Thank you.
In many ways, particularly Singapore. It's a magnificent place. I mean, to use one of our favorite words,
amazing. Yes,
so you could make an active decision to say, I want to adjust that because I have certain beliefs. But I think the key point is you should try and construct something that has 3 purchases in terms of your equity purchases, 3 different blocks through the ETF market, or for other markets through active investors. You make the choice yourself, but you should actively choose, rather than buying a world index, which has the concentration that we've talked about. You should try and you should make 2 or 3 choices to diversify yourself.
Yeah, fair. But that, I think we must be clear with the audience, that is on a few assumptions, right? We first assume that the story is as such.
Yes.
Right? Because
of
the
course.
financial markets, I think as of now, the consensus is not there yet, right?
Sure.
It's like, there's a little bit of a battle, people are fighting it out, but it's okay, broadly diversified still works, that's kind of like where it is. But you guys are like one of the few that at this size coming out to say that, this is how we see the world and we're going to deploy it differently, right? So you must believe in that idea first, and then you kind of then deploy the strategy. That's a fair statement, right?
I think it is a fair statement. I think the only thing is that I'm coming back to what you already said, is that the broad indices are less diversified than you might assume. So you need to do the diversification a little bit yourself.
Okay, fair. So I think in the forum, there was a little bit of a discussion of the Fed. Right, not because Dr. Janet Yellen was there, right? Like she's done, right? She's retired, right? Happily doing her thing, But I think for all the other professionals that are there was a little bit of this discussion of the Fed, because that is still a whole thing, or at least for a long time, that's been the narrative that everyone focuses on, whether the Fed is going to cut rates, or whether is it going to go up, and the whole central bank led kind of investment strategy. Would you say that that's done?
No, I think there's a couple of reasons why the Fed is still really important. I think the first is that if you think about in Asia, a lot of currencies are not necessarily pegged to the dollar, but managed against the dollar. And if you're a central bank in Asia and you're going to manage your currency against the dollar, you need to pay attention to what the Fed is doing, because you're probably going to end up doing something fairly similar. And so the reality is that the Fed is necessarily very, very important. Now, there are a couple of things that when we look at what's happened in interest rates this year, I would argue that actually the 2 central banks that have been precursors have been probably the Bank of Japan, which is the first to raise interest rates, but it didn't really have the same COVID cycle as everybody else. So it's doing different things. But the central bank, which was really the precursor, was probably the Reserve Bank of Australia, which has hiked interest rates 3 times, which was the first to hike interest rates. They've got interest rates back to where they were at the peak of the COVID years. And in a sense, I think other central banks are following them. So we're following your region of the world in terms of monetary policy. But the reality is, I think the Fed is probably going to be very important for two reasons. One is that they're going to set monetary policy, I think, for lots of the world. And probably our view is that they will actually, the market is saying they're probably going to have to hike. Our view is that in the fullness of time, they probably are going to ease. They're probably going to ease in the end of 2027. And I think Kevin Warsh has been pretty clear at saying we live in a world where, because of the technologies we were talking about, the medium-term outlook is pretty low price increases and low inflation because of technology. So that's his belief. And I think that he doesn't make all the decisions, but I think his voice will say, let's go beyond what's happening in energy today. Let's think about how prices are going to be set in the fullness of time. So I think that's one thing which is really important. The second thing is he is on record as saying he thinks the Fed should have a smaller balance sheet, should be less involved in fixed income markets. But at the same time, he's on record saying the Fed should work hand in hand with the Treasury. It may be the case that these two things lead to opposite conclusions. So our view is that probably the Fed, again, in the fullness of time, will not reduce its balance sheet all that much. But we'll see that if we look back on this, we'll see that central banks are comfortable with running relatively big balance sheets compared to what they've done historically. And the Fed will be leading the way, if you like, or being a thought leader in terms of how central banks should manage a balance sheet. So I think the Fed still does matter a lot.
Okay, fair. Interesting. Because, I mean, we all know that when the Fed adjusts rates, everyone else kind of move along. So what you're saying is like, okay, there is a good chance that in the longer term, not in the immediate future, but in the longer term, there should be some easing of rates, right? So it's probably going to come down. That's kind of how you're looking at it.
Our view is really, when we look out 18 months from now, the likelihood is that the Fed will have eased interest rates.
Okay. And you believe that every is a sweeping statement, but like the ECB, some of the major central banks, so I'll just kind of like emulate that, move along.
I think it's more. The ECB is a central bank in a very big independent currency zone. The ECB has hiked interest rates before the Fed. The ECB may hike interest rates again. Our view is that they will. They will hike interest rates again. It depends a little bit on how the situation in the Gulf evolves and how energy prices evolve. And they may end up in the fullness of time. It could take longer than 18 months, might be a couple of years. But as we look out to 2028, they might ease. So their policy could be a little bit different from the Fed's. But central banks in general do, in aggregate, move interest rates in similar fashions. And the people will look at their currencies against the Fed. So the Fed does continue to matter. Certainly.
Okay, fair. Yeah, and then there are many things that I want to ask you,
Great.
But I think in the interest of time, I will try to narrow down to two last big ideas, and one of it is what you've brought up, which is the Middle East, right?
Yeah.
So maybe just kind of share with us, like, what's the house view around the Middle East?
Yes.
And all that, because every week it's changing, right?
Sure.
So just
the news flow is changing.
Yeah, the
every
news
week.
flow is changing, but
I
the
would
fundamentals,
say our
right?
house view hasn't, fortunately, hasn't changed.
Okay.
We'd be exhausted if we had to change it every week. Our house view is that and we think about it in terms of probabilities, as a probability distribution. There's a 55% chance of what we call sort of managed conflict. The part which is most important in terms of the management here is with energy prices. So we think energy prices, the volatility was very high in the second quarter, but as we get into the end of the second quarter, it's declined. And there's a couple of reasons for that. One is that the world uses less energy to create GDP than it did in 2000. So there's been a steady decline in the link between energy and GDP. The second reason is that the world uses a bigger pool of different types of energy to create electricity in particular. And so we've seen renewable energy sort of being very important in the creation of electricity. And that's not just because we all want to be green citizens. Certainly we do. But it's also because it's inexpensive. Solar energy is inexpensive energy. So these are two things that have helped sort of dampen down the impact of the closure of the Straits of Hormuz And we think that will broadly continue. Now, there are two other scenarios. So it's a distributed scenario. There's a 35% chance that things are more difficult, that the scenario ends up being more difficult than we expect. And that would probably come about if the war continues, spreads, if we start to see that countries are running down their stocks of fuel and liquid natural gas in particular, we worry about, and natural gas in general, and that other countries really can't accelerate production enough to cover the gap. And then there's a 10% chance, which the markets have focused on this week, that peace comes relatively rapidly to the Gulf. Unfortunately, we say only a 10% chance.
That is as good as saying like, nah.
Well,
so we have, it's always a probability, but 10%.
Yeah, we have our doubts that what we've seen so far this week is really going to stick and is really going to lead to a full reopening in terms of the Straits of Hormuz. But that possibility is always still there. So that's our house view. And then we've talked about the implications in terms of fixed income markets and about central banks. Ultimately, we think that what is significant here is that the pass-through from higher energy prices to higher consumer prices is slow and partial because consumer demand is still going to be relatively soft. So Australia has led the way, as we said. The central bank in Europe is probably going to hike one more time. The US, we think, will wait a little bit. The UK will probably hike and then cut interest rates later on. But ultimately, we see when we get through 2026, we get on to 2027, there is some scope for policy to be eased because consumers in particular will be relatively weak. It may take longer in Europe till 2028, but we'll see that in the US and probably in the UK as well.
Yeah, fair. It's as if you saw my questions.
Okay.
Like the last...
I'm not looking over your shoulder.
Don't. Yeah. But the last thing I wanted to ask was really the health of the consumer.
Yes.
Right?
Yeah.
Because I think as much as the story ties into the idea that, okay, you want to diversify beyond the US, you want to look at the European region, you want to look at Asia, and AI manufacturing midstream, high-tech, high-value precision manufacturing. It's a lot is in Europe. Yes, it's true. And there's a lot of that in Asia. Yes. But the consumers in these spaces don't look very strong at this point in time, right?
Yep.
So like you see luxury being sold down here in Europe.
Sure.
You see the softening of the property market in East Asia.
Yep.
Right. So there is that whole question of like
the consumer.
Consumers. Because ultimately, you can deploy your money in different categories, right? Different sectors. So I want to hear a little bit on the take on consumers.
So we have a strong view that so a little bit of history here. If you go back to the consumer started to be the force of the economy, and particularly the US economy, starting in the early 1980s. Before the early 1980s, there was much more of a drive in terms of business to business and business to consumer. These businesses were equally significant. But you're absolutely right to say, starting with in the Ronald Reagan period in the US and accelerating, you saw the consumer, and particularly the US consumer, being the motor of world economic growth. But our feeling is that is changing, that we're moving into a period where it's much more about business to business than it is about business to consumer. And it's about business to business because when we think about AI, consumers use AI, but businesses are going to use it much more. When we talk about these drones that are washing windows, it's not a consumer who's going to buy the drone that washes a window. It's going to be either the real estate company or it's going to be a business which is working for the real estate company. So commercial services are going to be very involved in terms of being the ultimate consumer for a lot of these investments. The companies that are going to build these things are really industrial companies, which are not typically the consumer sector. It's much more the industrial sector. So a lot of conversation is about cyclicals. Should you have cyclicals, yes or no? Our view is that you should think beyond that, and you should think much more about focusing on cyclical companies which have businesses as their client, more than companies which have consumers as their client. And so the trend that we've seen this year, you're absolutely right. A lot of consumer businesses have suffered. Consumer staples has been about the worst performing sector in equity market. But that's not just a cyclical phenomenon. That's probably something which is more structural, which may last another 3 to 5 years as we see this real shift in what AI actually is.
Wow, that is a big statement. That is a big statement. Okay, so it's just to right size all that we have discussed, essentially the story that you've laid out, the ideas, it's within like the 3 to 5 year kind of like midterm time frame, right?
Correct. Yeah.
Okay.
But we talk about this is 3 to 5 years in terms of company profits and revenue opportunities, but equity markets are very, very good at anticipating.
That's a nice way of saying. Sometimes we run too ahead of ourselves.
Yes. So our view is that the equity markets will discount this future much more rapidly, and we will see that really being a trend.
Okay, fair. Thank you.
Thank you so much for your questions
that
and
was
your
great.
time.
We went around the world and all sorts of different ideas. In closing, do you have any last things you want to share with our retail investors out there?
Well, I want to share with them and with you. Thank you very much for giving me the opportunity to discuss with you. I really enjoyed it. And I want to stress to them there really is a lot of opportunity in terms of investing. It's a great time to invest. There's really lots of opportunity.
But it's always a great time to invest.
It's always a great time to invest. It's always a great time to invest, to save for the future. And the one thing is that have a broad investment horizon geographically, because it's a rapidly changing world and the opportunities are immense, but you need to look broadly.
Thank you.
Thank you.
Appreciate it. I hope you enjoyed today's episode. It was a very fun time here in Paris. I think we've learned a lot of stuff and we've discussed a lot of stuff with Guy. Very candid, I must say. And a lot of these ideas are not propagated with the other houses. So it's quite refreshing. And if you like what we do, head over to thefinancialcoconut.com to leave your email address so that we can get in touch with you. Once again, this was a fun trip with the Amundi World Investment Forum. I hope you enjoy. We'll see you next week at the next episode of Chills with TFC. Meanwhile, take care. Bye-bye.